Hi, folks. Welcome to the Ask Weekend Investing Round 58. Here in this series, we answer questions from our users, YouTube followers, anything about the markets or momentum investing or products. Disclaimer as always, please read fully, understand it, and then move forward in the video and do subscribe to this channel. So we've done 870 questions so far in 57 rounds, and all the videos of those rounds are available at a link in the description below. You can go watch them. Some of them can be very, very educative. And let's jump in. Uh, Kailash has the question. In your opinion, what is the objective of low volatility strategies? When you say low vol, does it indirectly mean low beta? Is low vol an approach to achieve a smoother underperformance or on par performance with benchmark? Can momentum ever be low vol? So good question. So low vol is a another factor type, just like when you talk about momentum or value or other factors. Low vol is also a factor strategy, and the objective is that you, as you very rightly said, that to achieve your objective with low volatility, and that necessarily, while does not mean low beta, but it tends to go there. And in general, I have not seen too many low wall strategies do very well. So that sort of has kept me away from this factor. But we are doing some more studies on this, and that will probably you know conclude for me whether we can include a low val add on to our momentum style or not. So my answer is probably incomplete right now, but momentum combined with low wall can be a more smoother ride. How good it is in terms of performance is something that I need to find out. So I'll come back on this whenever I can. And the next one is on from Venkat. What is the ideal or maximum number of individual stocks one should hold in their portfolio for optimal diversification without overcomplicating it? So most practitioners will suggest a 15 to 25 as the optimal number of stocks, especially if you are doing a discretionary investing style of investments, because then you are following each stock story, a lot of its daily news results. Beyond that, it may become very difficult to keep track of so many things happening in a non-discretionary system. However, I think 15 is no number. We could easily go 25, 30, 35, 40 as well. And for optimal, that sweet spot, that is about 20, 25, I would say, without overcomplicating it. Um, how many small cases is it advisable to hold to maintain focus and effective portfolio management? That will depend upon the type of small cases that you've chosen. If you have chosen, let's say, a specialist small cap small case, and then you have a specialist large cap small case, then perhaps you are missing out on significant mid caps. So depending upon what format of small case have you taken, let's say you take a small case which is focused on CNX 200 stocks and one on, let's say, mid and small cap stocks, then that's a great combination. Or one which has some gold exposure as well, and one perhaps which is more focused or concentrated, that can also work. So perhaps I would feel that no more than three is required, and two to three is something which is very, very sweet spot in nature in terms of numbers. Praveen says many investors feel they must understand what a company does before buying the stock, but in momentum investing, the focus is on price trends, not stories. That is correct. So, does trying to understand every stock actually get in the way of trusting the signals? Good question. If you are going to go the signal way, don't try to understand the stock, because that is going to, as you rightly said, get in the way of believing or having confidence on your signal. If your signal is not based on your understanding, then why should understanding come in the middle of it? If the signal is based on numbers, the fundamental numbers, the forecasts, the management talk, if your trade is based on that, then of course you need to understand the company in and out. But if your trigger is basis mostly price, then all that other uh, quantification is basically noise for you from your context point of view. It may not be completely invaluable, but from if you are not going to use that understanding to generate your signal, then that understanding is useless for this context. So if you are trading and investing with prices uh, or technical parameters, then fundamental understanding of it is not needed. But there are practitioners, for instance, Mark Minervini, he does a combination of both. So he will do elimination basis certain fundamental factors, but there also you don't really need to know what the company really does inside and out. So I would try to keep it very simple and not confuse myself in terms of uh, the noise in the signal. I have subscribed to MI20 in this dynamic world. How can we decide a stock needs to be purchased or sold in a week? Question is, there were many cases where stock was bought in week one, sold in week two, and bought again in week three. Can we provide a lead time to the stock to perform? So this can happen sometimes. The idea being that you could have stocks that were performing in week one, and week two they created some price moves uh, which were weaker than many other stocks in that particular cohort, and then price three maybe they started performing again. So it's like, would you rather be happier if, let's say, in stock 2 when it was displaying some weakness, and in stock 3 in week 3 it crashes? So what you're trying to do in week 2 is to trying to nip it in the bud. Sometimes you will be caught on the wrong foot, but that's part of the game. It is like saying that I want every transaction in my book to win. Then that is not possible in the real world. There is a certain strategy that you're following, and that strategy overall has yielded very good results. Sometimes certain parts of the strategy will not work, and that is the part of the pain that everybody has to go through. Because if there is a strategy where there is no pain, then it's a god strategy, right? That in this world is not possible. So there is a certain design of the strategy. Yes, in certain other strategies, if the design is more accommodative, perhaps this will not happen for that stock. That is also possible. That depending upon how tight or how loose the constraints are, you may not get out in week two. But if you will see over a year, perhaps there will be such one or two such cases that may happen, and that is part of the game. Sarita says, "Is it a good opportunity to add 25% gold to US top 10 to smoothen the bumpy ride?" So I think gold is a very good hedge, whether you are looking at India stocks or even US stocks. And when it is added to equity, it certainly smoothens the ride a lot. Uh, the fact remains that gold has been a asset class that has been ambushed very badly by the financial community in the last many decades, and it's only now that people are starting to wake up to it. But still I would think that, in times to come, gold will still add a lot of value to your portfolio. uh, Next question is, am I as an existing US top 10 investor, should we expect more US based strategies in 2025? So we will certainly be doing a lot of research. As and when we are able to crack some research, we will certainly add more strategies to this. So yeah, please stay tuned. On this question, let me also add that we have partnered with Vested, and weekend investing research strategies are available on Vested if you want to go for a US top 10, US based strategies. Arjun says, we will a portfolio of following structure outperform Sensex. Buy all stocks of Sensex which have positive 1 year rate of change. Exit when ROC becomes negative. ROC over how many period? How long a period? 1 year. Equal weight. Yeah, I mean, I think this is a very very simple strategy. It potentially should be able to beat the index. There will be certain time periods, especially near the market turns, where this will lag a lot, because let's say something has gone up 500%. 300%. For that 1 year rate of change to become negative, it's going to take a lot of time, and the stock would have dived a lot by then. So it is possible that it will beat, but it will potentially have significant volatility as well. Divyam says, can you please guide me on asset allocation mix ideal for me, 27-year-old working in corporate tech, asset allocation at a broad level, equity, debt, gold, US equity, within equity, large, mid, small cap, flexi, how frequent I need to keep to balance. I have emergency fund, required insurance policies already. Please take my question. Okay, so the question is taken, but as a diktat from our regulator, we really can't give advice to you on your personal allocations. But in general, I can say try to have allocation more towards equity. You are very young, so you can keep more towards equity. Certainly have some gold, certainly have some US equity. And within equity, you can divide it more towards risk, less towards safety, because you are young. But more than this, I think you will need to find a financial planner for you to advise you on this. Saikiran says, in your recent video of what if we miss few important days in the market, you are implying one should not panic sell and stay invested. So this could be one of the inferences from that, but I also implied that, and I mentioned in that video that stay invested only if you have a strategy in place. Otherwise, you have to cut your loss somewhere. So if you have a strategy that you know will build itself back, so let's say you are in a rotational momentum strategy and market is falling, so some of the stocks will get out, other defensive stocks will come in, and so on and so forth. So there is a strategy that will take you through that motion, and eventually once the market is doing well, you will do well. But let's say you have a discretionary portfolio of 20 stocks and all those stocks are crashing. Now if you just hold on to them and stay invested in them, perhaps those 20 stocks are not going to see the next bull market. Perhaps some other stocks are going to see the next bull market. So, if there is a self correcting, self healing strategy that you are invested in, then fine. Don't panic sell. But if you are having no strategy, then certainly you should panic. I hope that is not the case, but if that is the case, certainly you should have. In fact, on this question, I can also say that most people, when they are buying a stock, never think about the exit. So always think about exit before buying, that I am buying the stock for xyz reason, and as soon as that xyz reason is not getting satisfied, I should be getting out. So when you buy a stock, you are buying it because of conventionally, because of results, because of management talk, because of prospects. But you sell basis the price. So which is not right. I mean, had you bought basis the price, yes, then you sell basis the price. But if you bought basis a thesis that this company is going to become the next HDFC bank, then you have to figure out in your mind at what point will I cut myself, not because of price, but because of fundamental change of that company. So this is something that you can think about. Appa Rao says, I'm a novice investor. I want to know how to apply momentum to your basket of small cases for initial investment. Should I go for a small case which is at all time high or a small case which has the maximum drawdown as on today? So small cases which are in drawdowns are a good place to start, no doubt about it. But always have a large time frame in mind when you come to the markets, so that you can ride the entire full cycle. And for that, if you're going to be in that small case for 5 to 7 years, perhaps that small case is going to perform for you. So regardless of exactly trying to time it, see what small case fits your uh, requirement. Are you a conservative investor? Are you aggressive, concentrated investor? All those requirements are more important than trying to time it this way. Second question is, if all my investable capital is deployed with weekend investing at any point of time in the future, I will be requiring money and not shares. Taking this uncertainty in context, as market has no obligation to rise in meeting my unexpected cash requirement, I am a strong proponent of absolute momentum than rotational momentum. Uh, I'm not sure if emergency money should be drawn from the market. Market should always have that segment of your money which you will not need in an emergency. So first of all, uh, Secondly, between absolute momentum and rotational momentum, yes, absolute momentum sounds and feels more uh, safer. That as markets go down, you come to cash. But what has been seen is that rotational momentum has been performing better than absolute momentum. Also, because we have not seen any major crashes in the last 5 years. And if you remove COVID, then we've not seen anything big in the last 6 or 7 years. So rotational momentum has done well in this kind of a environment, and I would say that in case you do like absolute momentum, do keep one strategy of rotational as well. So we are at the end of this Ask Weekend Investing round. Thank you so much for sending in your questions. I hope I was able to answer some of them to your satisfaction. If not, send us mail if there's any burning question that needs to be answered and I was not able to take it. Do send it in. And all the previous episodes are here. Go through them. Most of the questions that you would have in your mind probably are answered somewhere. So certainly, instead of the weekend Netflix binging, perhaps you can binge on these videos. Thank you so much for watching. Do like and share these videos. Thanks. Bye.